Government expects the local economy to grow at 1.3% this year, and it admits this level of growth is far below what's needed to address the high unemployment and poverty rates. It blames the power cuts, logistics challenges, as well as the high inflation environment for the weakness. Unemployment is expected to remain elevated, with the low investor confidence hindering investments that could be creating jobs.
We have embarked on a broad structural reform agenda that aims to address the challenges that held back our growth. This agenda included areas like electricity, logistics, water, telecommunication, and visa reforms. The budget review details the good progress that has been made in these areas over the past few years, but obstacles remain.
Revenue collection is projected lower by just over 56 billion rands as a result of reduced corporate income tax and value-added tax. This is because of the lower profitability in many economic sectors, especially mining, followed by manufacturing, testament to the electricity and logistics challenges the economy is facing. Government debt remains a headache, with National Treasury saying government debt is expected to increase on the back of a lower revenue collection and higher spending. Gross loan debt as a percentage of GDP is now expected at 74.1% of GDP. It is lower than the estimates in the October midterm budget policy statement because of the distribution of the gold and foreign exchange contingency reserve account from the Reserve Bank, giving government 150 billion rand over the medium term.
We're giving you this money. We are going to experience sterilization costs. And because we are going to experience sterilization costs, we need to be compensated for that. And the agreement with the Treasury is that 100 billion will go back to the Reserve Bank so that we can pay for those sterilization costs over a period of time.
Contingent liabilities from struggling state-owned companies remain a risk, with approved guarantees to state-owned companies expected to increase by 33 billion rands to just over 500 billion rands, the majority of the exposure being from Eskom. Currently, 20 cents of every 1 rand collected goes towards servicing debt. Government spending increases to almost 2.4 trillion rands this financial year. This leaves the budget deficit at 4.9% of GDP. Risks to the domestic outlook remain over the near term. They include the continued electricity supply constraints hindering economic activity and the logistics challenges obstructing exports. The high inflation and interest rate environment also continue to suppress household consumption spending. It's expected the slowing inflation and increases in investment in energy-related investments will help boost economic activity from the forecasted growth of 0.6% last year.
I think ratings agencies will like this budget, the fact that fiscal consolidation continues strongly as a policy, that the debt ratio is reduced, and the fact that expenditure targets are far more realistic in this budget than a year ago, in terms of the wage bill and in terms of the SRD grant. So I think ratings agencies will like it. They will continue to warn about the lack of economic growth and future expenditure risks, but overall it's a far better budget than what they would have expected as well.
Government says it plans to put the economy on a firm footing by prioritizing reforms such as creating a competitive electricity market and an efficient port and rail logistics system. Transnet was granted new guarantees of 47 billion rand, with 22.8 billion rand available for immediate use. National Treasury says the guarantee is mainly to address persistent challenges relating to liquidity and supply chain backlogs. Fakomosi, SABC News, Parliament.